I didn't know what I didn't know about taxes at that point. My time in Rochester, I barely paid taxes. And at that point, it's like, hey guys, we're running out of money. If we want to go bigger, like we can't, if you want to buy $1 billion, like we can't write a $10 million check into these deals. So I think it depends on your personality type and really what your goals are. Because there's benefits of both. For me, I had been investing passively into deals already while I was still in New York.
What is up, everybody? Welcome to the Go Big Live Real Estate Investors Podcast. I'm your host, Matt Druin, and I am psyched out of my mind today to have an old friend of mine, Mr. Jack Krupey. Jack and I actually met at a gym, Midtown Athletic Club in Rochester, New York, back, I don't even know how many years ago. But a little bit about Jack is he is an experienced real estate executive of more than 20 years. He is the founder and CEO of JKAM Investments, a company providing access to private advisory services for real estate and alternative investments. Jack focuses on investment and management of different asset classes. Previously a real estate broker, wholesaler, landlord, and Wall Street employee, he transitioned to offering passive investing opportunities to accredited investors. And I can tell I met Jack when he was like, in the trenches doing wholesale deals and fix and flips and all that stuff, and seeing his journey for where he is to where he is today. And throughout his career, Jack expanded his connections. Today, his vast network is composed of long-term relationships with skilled real estate developers, sponsors, and syndicators. And he is going to go into some case studies today, and also his journey from where he started in the trenches to where he is today. He's put together over $3 billion worth of real estate deals. So I'm excited to talk about that as well. So thank you for coming on the show, Jack. I appreciate it.
Matt, it's great to be here. Thanks for having me.
Excellent. All right. So first question, you were born and now you're here. What happened in between?
Wow, it's a great way to put it. And it's definitely been a crazy ride. So actually, grew up in New Jersey. Was really, into computers in high school. It was the early days of the internet, AOL, Prodigy. And, at the time I saw that, if you major in computer science or information technology, you're making $50,000 out of college. And like back then, I think that was about what my dad had made. And I'm like, wow, I'm going to make more money than my dad right out of college, which I never ceased to let him know about, but he was very proud. Really dove in. I went to Rochester. I went to RIT because they had a specific major in information technology, which was really internet focused and less programming focused. And enjoyed it. Assumed I was going to be some type of computer consultant or executive, and then the .com crash happened. So, kind of learned early on that the rug can get pulled out from under you, and the world can change pretty quickly. And that's really something that's kind of led to various decisions over the years, because I've learned some of those lessons early. Because of that, I did have a job. I had good credit and had a job, so I was able to get into real estate sort of during that first rush, that 2002, 2003. And as you mentioned, I did some wholesaling. I did some low to no money down deals, just built up a small portfolio. And within 2 years, I'd quit my computer job and was full-time hustling in real estate. And had a couple good years there, but also made a lot of rookie mistakes. And ultimately, I was undercapitalized as well, just because didn't have a lot of time to build a nest egg up, and a lot of the properties had relatively high leverage, and made some mistakes, went into some areas, some of the lower, rougher neighborhoods, just chasing yield, where I probably should have stuck to some higher quality properties, and certainly had some challenges and lessons I've learned that I've learned from over the years. So, so I took some lumps, like a lot of people did, but not as bad as those who lived in California or Nevada, where properties dropped 50%. But then, an interesting thing happened to me in 2008. When all these loans started going bad, and since I grew up in New Jersey, I wanted to move back towards New York City. And there were a number of hedge funds and private equity funds buying these bad loans, these non-performing loans, and they needed real estate people, because these are a bunch of bankers who didn't know what they were doing, and they needed somebody who had bought at the auctions, who could look at a property, pull the comps, and figure out what's the price to make sure that the local hustlers that buy at the sheriff's auction aren't ripping them off. So I sort of backdoored my way into Wall Street. And 2008, I was working at 30 Wall Street, and company had just bought this giant portfolio, and I spent a few years in-house at a fund. Then then I went on my own, and then it kind of caught this crazy ride of partnering with a family office, and then eventually partnering with a private equity fund, and bought a few $1 billion worth of loans. All the while I'd started investing in syndications myself because I didn't have the time to invest in single family houses, and I knew some of the struggles of having done that. So, sort of in parallel was investing passively. And then eventually, once I, kind of burnt out after a while from the Wall Street grind, and eventually ended up getting bought out from the firm, had a nice pile of cash, and then decided to build my new business, where I'm investing my own money, but also I manage 2 Reg D 506c funds where investors can invest alongside me into various syndicated asset classes: multifamily, self-storage, mobile home park, some ground-up development, really various classes, but primarily real estate related.
So there's a lot to unpack there. So let's back up a little bit in terms of jumping out on your own and wanting to sort of like replicate this business of buying distressed debt, but maybe in, starting up like a mom and pop shop and that sort of thing. So tell me how you got started in that.
Yeah, so it was, luckily I became an entrepreneur pretty early. I had, 1 or 2 years with a tech job while I was getting started in real estate, but, very early on, I broke the golden handcuffs once in my early 20s. So, at least I knew I was capable of it, and I knew what it was like, and I knew it's not always easy. But ultimately, I saw the money that was being made by some of the investors that were buying the loans off of us, and I knew I wanted to be on that side, and I wasn't going to make that kind of money as an employee. So it became a pretty easy decision. There was, there were some disputes over commissions and money that I was owed that I felt, that they weren't meeting their obligations to me. So ultimately, it came to a head, and, it just became an easy decision for me to leave. And, the first 6 months to 12 months was rough. I was, trying to raise money I had a bit of a track record with a couple deals, but I was primarily, again, wholesaling or bird dogging for a few of the investors I had gotten to know. And what I did, though, is I was tracking their track record along with mine. So if I found them the deal, I got permission from them. I'm like, hey, I'll basically help you for free on this. Let me just get a track record of what's happening and show the profits and the exits. And then about a year in or so, just someone I met through a commercial real estate network, because I'd also kept my broker's license, who owned some buildings in New York and was, said he was looking for opportunities. I basically showed an Excel spreadsheet of where maybe 3 or 4 deals were mine, but the other 10 or 15 were deals I tracked and found and worked through. And that was enough to raise a few $1 million. Now, that wasn't a check just given to me. That was we're starting a company together. I control the money. I want to see every asset we're buying. But it was enough to start a real business with a JV partner, and basically get the first couple $1 million going where I could support myself somewhat comfortably.
Now, were you looking for a person like this at the time, or did this like happen by accident? You just went to a meetup and struck up a conversation like after drinks were flowing? Like, tell me about that, because I think a lot of people kind of like, oh, well, they hear about the kismet that happens out there in the world, and people start to think like, oh, it's like luck, it's all that stuff. But I think that if you come about in the universe with intentionality and focus, and you have a track record and that sort of thing, and you put yourself in the right rooms with people, it can lead to you having better luck and better prospects. So tell me about like kind of how that like initial meeting like happened. Like, were you doing this on a regular basis? Like, tell me all about that.
Sure. So it was closer. It was certainly, there was certainly a lot of intentionality, but it wasn't the most organized process either. It was, I'm definitely an outgoing person. I'm definitely, any conversation, the elevator pitch is going to come out. Was definitely strategically looking for, the right people to talk to, but it wasn't like I was on a road show and had a list of 500 people and was just calling every day, doing the same pitch in a very organized fashion. It was, I was also still, brokering loans, buying what I could with my own money, talking to even smaller investors about doing, a onesie, twosie joint venture. So, those conversations were happening regularly, but ultimately, the first bigger deal there was a local conference for commercial real estate that had a list of people, because I was also potentially trying to broker larger commercial transactions and non-performing loans on larger deals. So I essentially hit up everyone who was at this conference and said, "Hope you enjoy." I didn't even go to the conference. I was basically, "I hope you enjoyed the conference. Let me know if we could talk about deals." And I got a few responses, and met a guy for coffee. And this was actually a few months before I pitched him. It was really just to get to know you. It was more for sourcing commercial. But as I got to know him, over a month or two, and knew the situation, I was basically like, "Do you know anyone who may be interested in that?" Which is, it's one of those softer ways to ask for capital, is, do you know someone, rather than like, "Hey, would you be interested yourself?" And got a response that said, "Yeah, come pitch me." And brought that track record and a couple page, pretty simple business plan. Like, it wasn't like a 50-page thing. It's a couple page plan, high level. And it's a pretty simple business model. You buy loans at a discount, you modify them, or you foreclose on them. And it was surprisingly quick. And then that's actually the second time that happened too, because in Rochester it's much smaller scale. But one of my IT clients, on a kind of a random conversation where I was like, "Yeah, I want to kind of quit my job at some point and do this," was like, "Okay, well, we'll give you a couple $100,000 to buy a couple buildings." So sometimes it's certainly not luck, because you make your own luck, and all the things you set up in the meantime will contribute to it. But I probably, who knows if it would have happened faster if I was a little more organized with it. But at that time, I'm also just trying to keep the lights on. So I think the moral is, there's no one right way to do it. Some people may be super organized, make a list of 100, do 100 pitches, and other times you're just kind of putting it out there all the time, and like you said, the kismet works.
So I'm definitely sensing a theme here after doing almost 50 of these interviews, that a lot of the people I talk to don't even, and these, there's absolute beasts that have been on my show before, and most of them kind of use the Tasmanian devil approach to, getting started. And they're just taking action. A lot of the people that are, very, very organized, very analytical, they'll spend like 6 months coming up with a plan. Oh, I need a CRM system. I need Podio. I need a website. I need business cards, and all that stuff. And then by the time they put all that energy into all that crap that really doesn't move the needle forward, they're like burnt out already before they even took any action that will move things in their direction in the universe. So kind of like, what do you say to that?
Yeah, no, you're 100% right, and that's certainly the way I operate, and a majority of the other successful people I know operate. I think Tim Ferriss had talked about these like experiments, or you fail quickly, or just do these mini tests on things to see what works, and avoid that analysis paralysis. And yeah, that's definitely the way. I love that Tasmanian devil reference, by the way. I may quote that in the future.
Absolutely. So take us forward a little bit. Granted, you were able to essentially partner with this person, JV with them on creating this company that is, focusing in the distressed debt space. Take me forward in the story from there and what happened next.
Yeah, so at that point, we had started with a few $1 million, and we're just working our in-house portfolio. We had no other outside money, but we were constantly buying and selling. I had advertisements on LinkedIn for those who might have wanted to buy performing loans off of us, that we wanted to buy non-performing, that we were selling non-performing. So in addition to certain loans we would hold through fruition, if it was a good deal, we bought it really cheap. Sometimes we just hold it and foreclose. In other cases, we would get it reperforming, and eventually we want to sell it at a profit. So just by being active, I got this random LinkedIn request from a CIO of a fund. They had like a very bland website that just kind of had their name and an address on it and 2 locations, and no information about them. I thought they could have been 2 guys from Long Island that wanted to buy 1 loan. And instead, I walk into a meeting at a nice hotel in Midtown Manhattan, and there's 5 of them there, and it turns out they were all ex-Bear Stearns executives that had basically a portfolio company underneath Bear Stearns that pretty much got shut down when Bear Stearns was sold to Chase, and they were restarting their business, and they'd raised $150 million. And they wanted to get into the mortgage space, the distressed loan space. They weren't allowed to at Bear because Bear had a separate division, but now that they were on their own, they wanted to get into the space, and they saw that we had, a bit of a track record, and frankly, we were just small enough that, we were a better fit for them. They didn't want to just be some passive investor in some other big fund. They wanted to learn how to do it in-house, and we had enough of a track record and the right team to basically for them to work with us on a joint venture. So because we were active, because I pitched the first guy for a few $1,000,000 and we started doing deals, all of a sudden this opportunity, and at that time I had no clue it was going to turn into what it turned into. It was what they referred to as a $5 to $10 million science experiment of buying loans together. So we bought some loans together in a simple joint venture structure. We co-invested a little bit of money. They put up most of the money, and then we got a higher percentage of the profits as long as they beat, a certain return. And at the time, as a kind of a simple real estate investor, I was still thinking in terms of cash on cash return, but all they care about is IRR. And as I've moved more into apartment investing, IRR is much more common. But a lot of pretty seasoned real estate investors I know tend to not fully. Either not use some don't understand, some don't use it. And, it was certainly a learning experience for me, even on those early stages. Fortunately, the first 10 million went really well. Then it went to, okay, let's do up to 100 million. And, that was going pretty well. And we were still co-investing. It was down to a 1% co-invest. And at that point, it's like, hey guys, we're running out of money. If we want to go bigger, like we can't, you want to buy $1 billion, like we can't write a $10 million check into these deals. So ended up kind of merging into a new business, a new company that I owned a percentage of. And one of the things that came to fruition years later is I didn't know what I didn't know about taxes at that point. My time in Rochester, I barely paid taxes. I was a real estate professional and got all the depreciation, but I didn't really know it. I just knew, I'm not, whatever it is, I'm making some money, but I'm not paying taxes. And all of a sudden, in Manhattan, paying a 50% tax rate with like a high salary and a high bonus and a K1 owning an active business where I'm losing half of my money and I'm in, the second highest cost of living area in the country. So, although I was learning a lot, I was still a bit of a fish out of water because I'm an entrepreneurial person and I was making more money than ever, but losing half of it and being stuck at a high cost of living without controlling my time anymore was really starting to eat away at me. And, just learned some life lessons about, money is not always the most important thing. It's your happiness. And for me, a lot of that derives on the control of my time and my freedom more than money itself.
I want to back up a little bit on the LinkedIn request. How did this guy even hear about you?
So, I was a member of many groups. I was posting, we had loans for sale. We were posting about active things like, hey, we have, a number of loans. We have a non-performing loan in this state, contact me for more info. So there was activity. So that's the simplest answer. And I know this was circa 2013, and now it's even way, way more important to have that personal brand and have that, just putting yourself out there because it's, social media is really, really taken over since then. So yeah, it was just that activity of having, seeing that I was an active participant in the business.
Value-based content marketing before it was even a thing. You were doing it probably unbeknownst that that's what you were doing, is that you were providing value by being an opportunity guy, right?
Yeah, absolutely. Absolutely. And, there's moments I've lost sight of that just when I went back on my own too, just because, when you're on the private equity Wall Street, we actually got a little more secretive. Once we were in business together, it was like, less posts because they didn't want anyone to kind of understand the secret sauce or, it's sort of that Wall Street mentality. But yeah, as far as an entrepreneur trying to stir up business, raise capital, get deal flow going, yeah, there's no substitute for value-based content, whether it's deal flow, whether it's education, there's no substitute for that.
Now, we were talking in the green room about you got to a moment of being burnt out, was there a confluence of factors that kind of led up to that? Or was there like one thing that happened after maybe the confluence of those factors that were just like, dude, I got to do something different?
Yeah, I mean, it's certainly built over time. So, confluence of factors, but I think what it ultimately comes down to is I was in the wrong seat at that point. I'm a guy who wants to run a business, not work a business. If the E-myth, the 4-hour work week, doesn't mean you only work 4 hours, but I really think of myself as a business owner, not an employee. And when you're merged into a much larger company that's primarily private equity guys, investment bankers, that type of space, where the culture is to, sit at your desk 80 hours a week, whether you have something to do or not, just to kind of be there with everyone else. And then just even the roles, and there was things that were kind of over my head at that point too. Like, I'm not this Excel financial modeler who could work with the securitization people at Goldman Sachs to use this really extensive model to model out yield curves on portfolios. So, ultimately I'd sort of, my attempt was to kind of work, replace myself, if you will. But once you're, when you're when you're a founder that's sort of merged with another company, when you replace yourself, eventually it's, if you don't find the right role or the right seats, it's often time to go. So the other part of that was, the taxes. And one of the things I realized was we weren't going to get carried interest because the way it was structured, we weren't the main fund. We were sort of a smaller service provider of the main fund. So, what I thought was going to be 20% capital gains, a lot of it was going to be 50% ordinary income. And that was the difference for me from hitting my number in a few years or not hitting my number. So that caused me to really dive into various tax options, and ultimately I landed in Puerto Rico. However, in hindsight, there's plenty of other, there are a number of other options as well, although it's the most difficult for high earning W-2, Wall Street bankers, doctors, lawyers, senior engineer, tech people. It's the most difficult way to, the least amount of loopholes and ways to offset your taxes is that category I was in. But there are some, which probably more for another episode, but if your spouse is a real estate professional, for example, I know a bunch of high earners that are able to have their spouse manage some properties and they could defer a significant amount of taxes. So that's one of the things I go into in depth when I do like a more long, like a formal speaking engagement or something. There's a lot of really interesting tricks if you can structure your life properly. But really, that's what started my dive into the tax efficiency. And I'm not a CPA or an official advisor, but I know enough to point my friends, clients, colleagues, investors in the right direction with their CPAs to help create an efficient a tax efficient plan and an efficient investment portfolio.
Absolutely. So speaking of speaking engagements, we have you coming into Rochester in the not too distant future. And by the way, if you're listening to this in other parts of the country, we're going to capture that workshop that Jack is coming in to speak on about OPM, OPM Mastery, a guide to raising private capital. In addition to being on the side of capital raiser, finding deals, doing everything, we're also going to talk about a couple other things in addition to that, because there's multiple stakeholders to the OPM space. There's the people talk about the OPM as like that doctor or lawyer or somebody who sold their widget business for $20 million that you need to build a relationship with. But what's interesting is we're going to talk on the other side of that, on the other side of that equation too. So kind of tell us about what people that are on the other side of OPM, the people that actually have the money, can learn from, or what they need to learn in this space in order to be successful and achieve their goals.
Sure. So I think there's really an underserved community of like the accredited investor that's worth between say 1 and 10 or 1 and 20 million. You don't have enough money to have a family office and have your own internal support staff. And a great majority of them, and I've seen many statistics on this, have 80 or 90% of their money just in stocks and bonds in the traditional financial system, which, there's plenty of good, honest financial advisors, but unfortunately there's also a lot of advisors that are really just glorified salespeople, and there's so many levels of fees, and I think it really does take away from returns. And if you look at statistics of those that are worth 50 to 100 million, the higher net worth, most of them have a great higher percentage of their wealth in real estate, in private equity, in private credit. So I really think, and the laws changed in 2012 for advertising. Really before 2012, it was difficult to really find the deals. You might come across one in your country club, but the access to the information is a lot more accessible now. So I think that's really good for investors in general. So there's a whole world of private placements. In real estate, multifamily is one of the biggest asset classes. There's also self-storage, mobile home parks. We recently invested in a marina that has an RV park component, and also some Airbnbs that are actually boat houses. So there's a lot of opportunities out there, and because they're not publicly traded, you can't click a button on E-Trade. They are more difficult to find. You have to spend your time and energy to find the right operators or groups that have access to the right operators. And so it's passive investing because you're investing with, it's essentially a small private equity fund, and there's what we call the operator or the sponsor. And they have to provide higher returns than the market because it's a less efficient market, and it's more like owning or investing in a business. So certain investors have said, well, it sounds like it's too good to be true. How do they potentially give you a 15 or 20% return instead of this S&P at 8%? Isn't the market efficient? And the answer is, if it were as efficient as you can click a button and you had all the investment banks analyzing all the deals, it probably would be. But because it's harder to raise that capital, you need to provide higher returns. And in addition to the returns itself, the returns are often tax deferred, because one of the best benefits of real estate is that depreciation, and especially if you're a high earner. If you're paying that top tax rate, 37% federal, and for those in high tax states like New York and California, it's often almost a 50% bracket. Earning tax deferred income is a big part of your actual return. I think a lot of people will overlook that, including people who may own REITs in their stock portfolio, and REITs are not a qualified dividend, as an example. So sometimes people are paying almost a 30% tax rate on their REIT dividends, whereas the same investment into maybe a similar portfolio of multifamily buildings would earn them a tax-free or a tax-deferred return at that or higher. So kind of off on a tangent there, but it's about finding that access to these opportunities through going to events like we're running. There's a number of national conferences. There's tons of podcasts, including yours and mine, that cover parts of this industry. So the first step is just being aware and education.
So on the OPM raising side of things, I want to ask the question. It's an old question. So what comes first, the deal or the money? For those that are looking to swim upstream into bust through the ceiling into larger commercial income deals.
So I think it depends on your personality type and really what your goals are, because there's benefits of both. For me, I had been investing passively into deals already while I was still in New York, and I had this exact decision to make. I ended up with a decent buyout, had a fair amount of liquidity, and I decide: do I want to become a full-time operator, pick one or two markets, and be this full-time operating business, and also still have to raise money, or do I want to partner with groups that I already have vetted, that have already had success with me, that I think are probably better at operations than I would be, because I've always been more of the networking deal guy. I think my best skill set is that connector ability I have. So I chose to focus that the money comes first and build a business around. And I looked at, what do I like to do? I love to talk to these operators who I have a lot of respect for, who have already made me money. And I love to talk to investors and make them aware of what options are out there, talk about the tax efficiency, talk about their goals towards retirement, how these investments could be a better fit than what I consider kind of the subpar returns of the traditional wealth management of in stocks and bonds. So I chose to start the business in this capacity. And what I love about what we do is it gives me the best of both worlds, because once you have the money, you could actually negotiate better terms with these groups as well. So I, in most cases, don't really cost my investors anything, because we get a better deal than they would have got if they went directly. and I capture some of that spread. So it really is a true win-win, and the operators love working with us because it's not easy to raise capital. I mean, even a $50,000 check, for example, there's going to be multiple phone calls, emails, questions, answers, and for us being part of their team, we raise $500,000, $1 million even if they're raising 10 million total. That may be 5 to 10 investors they don't have to talk to that we're talking to, and they're happy to give us better deal terms because of that, and because we're doing that consistently. There's a number of groups that we're involved with the majority of the deals that they find, and it's very difficult to find deals as well. So I know a lot of groups have said, well, especially 2 years ago when it was a very competitive market, it's like, how are you finding anything? And it's because each of our groups may look at 200 deals to find one good one. And we've got 15 groups that are each looking at 200 deals. So of the 2,400 deals, there's 12 good ones a year. And so when you're on the capital side, the deal flow is coming to you more. Now, on the operator side, if you're that good at operations and you're going to run that business, like if you're that wholesaler who's already built that model and you're going to cold call and send postcards and really, really hustle, you could certainly make a higher margin because now you're getting property management fees, you're getting other fees. So if your skill set is there, so be it. I'm not dissuading that, but at least for me, I chose the money comes first. And I'd say for a lot of the higher net worth, if you've already made it and you've got a decent sized portfolio, or you're that high earning professional, you're a doctor, you're making $500 an hour already, what's the highest and best use of your time? I would say it's spend the time, vet operating partners that you're comfortable with, test it out yourself, and then spend your time recruiting your network, and you can actually build your own fund or your own business. And in a very it's not fully passive because you do your work up front, but you're not the one getting the 2 a.m. phone call for the roof that's leaking or the toilet that's overflowed. And I think that's a much better use of time for most high earning professionals, or those that have already built a few $1 million net worth.
Now, we're wrapping up the recorded version of this podcast here before we jump into the live Q&A with our live studio audience. For those of you listening, this is like the Oprah show for real estate investors, so to speak. Jack, a lot of the people that listen to this show are, they have a couple single family rentals, they have maybe a couple duplexes. They understand that, yes, it was great to get my feet wet in this business and learn the ropes, but at the end of the day, these deals are paying me chump change, and I want to swim upstream into larger commercial deals and doing stuff that's really going to move the needle in terms of allowing me to achieve the financial goals in my life that I want for myself and my family. What are your words of advice for them in terms of the first steps they can take right now to get moving in that direction?
Yeah, I think it starts with understanding the larger deals in general. That could be listening to podcasts, reviewing Bigger Pockets, joining a coaching program, going to one of the conferences. I know there's every month or two there's a big multifamily or syndication conference somewhere, and they're usually in places you want to go. Although I think there's one called the Best Ever, which is in Salt Lake, which is probably the least exciting place, although it's a beautiful city. Although if you're a skier, maybe you hit Park City. But usually the conferences are in Orlando and Vegas and Miami, or places you can make it a family vacation and write it off even. But you have to make yourself aware of what's out there, and the information is readily available as it's ever been. But you obviously have to weed through and find the right network. And nothing substitutes a personal referral. For me, it's always also, it's not just the operators or the sponsors or the people that are looking to get your money. It's finding the other person that was in your boat a year or two ago that's already invested some of their own money into deals and is having success, or even had some struggles. Not every deal is always a home run, and there's some deals. If a deal was bought in early 2022, just right when rates were starting to go up, there are some deals that have some headwinds right now just because of the interest rates, regardless of how good the property is. So it's not foolproof. Just like the stock market was down 20% in 2022. It's not. I don't want to sound like every deal always goes perfect, because there are sometimes challenges. So it's about that taking action. It's the theme of everything. Is my LinkedIn posts turned into $3 billion of deal flow, and go into an event in Rochester, or go into an event in Miami to learn and educate and meet other investors. You never know what it turns into, and there's no one right path.
Excellent. All right. Well, sounds good. If you are listening to the show right now and you want to get in the exclusive live Q&A and get access to these episodes weeks in advance of when we release them, you have to join our Facebook group called the Go Big Live Real Estate Investors Group. If you don't have a Facebook profile, just create a dummy profile and search for the group and request access, and I'll let you in. So you can get access to absolute beasts like Jack, like Gino Barbaro, Matt Faircloth, Reed Goosens, Ashley Kerr, Chris Seveny, Brian Burke. The list goes on. You got to join us in that group there to help you level up and educate yourself. So, Jack, thanks again for coming on the show. I appreciate it. Our live studio audience is patiently waiting in the backstage. So let's jump into it. Thanks for coming on the show.
Thanks for having me.